Buy-to-let is the most popular type of property investment strategy in the UK. A buy-to-let allows property investors to purchase property specifically to rent to tenants, generating a rental income. This is known as a rental yield. The property can be either residential or commercial with a buy-to-let strategy. Often, property investors start with residential and add commercial to their portfolio as they expand. The buy-to-let strategy is the oldest form of property investment in the UK, creating the boom in landlords and rental sector. Pros: buy-to-let is an established strategy and seen as low risk compared to other strategies. This strategy has a dedicated type of mortgage known as a buy-to-let mortgage. Several key lenders offer these types of mortgages, making finance more accessible. As the property investor, you can benefit from two types of return: the rental yield and capital growth. This is when the property grows in value over time. Typically, the rental yield of a buy-to-let is a lot more attractive than savings or pension returns if the property is tenanted. Cons: buy-to-let often doesn't generate the highest rental yield compared to other investment strategies such as HMO. This type of strategy is seen as long-term to allow the property to increase in value. If the property is empty, no return is generated and an investor may have additional costs such as council tax or business rates to pay. Tips: before investing, research the level of tenant demand for the type of property and location you are looking to invest in to ensure you can tenant the property quickly. If you aren't very hands-on, think about how the property will be maintained or if a new build would better suit your strategy. Treat your buy-to-let as a business. Don't get personal with decoration or furnishings. After all, a buy-to-let is an investment.